Welcome back to Block 101, home on value investing in disruptive innovation and tech. And today I just want to talk about the industry life cycle and why I believe some of these growth stocks, like your normal FANG companies, that's your Facebook, your Amazon, your Netflix, and your Google, are due for a correction, and why I think stocks will drop. So for those of you that don't know what the industry life cycle model is, I'm going to put it up on the screen, and it just basically shows the demand on the y-axis and the time on the x-axis, okay? And it's generally a slope, curvature. So you've got the embryonic stage, you've got the growth stage, you've got the shakeout, maturity, and you've got the decline. So during the embryonic stage, you've got slow growth, high prices. It takes a significant investment, it's very high risk. During the growth stage, you've got rapidly increasing demand, improving profits, falling prices, and low competition. During the shakeout, you've got slowing growth, intense competition, declining profitability, and a focus on cutting costs. During maturity, you've got little or no growth, industry consolidation, and high barriers to entry. During the decline stage now, you've got negative growth, excess capacity, and high competition. Okay, so if we take social media networks, for example, let's use Facebook. If we look at Meta, their PE ratio is 33, which is basically suggesting that markets still believe they've got room to grow. If you look at their income statement, they are profitable, they are making money. Now, in terms of financial strategy during the industry life cycle, you've got different requirements. If you're in the mature stage, which I believe Meta is in, you've got low to medium funding requirements. Okay, you don't really need to seek capital from external sources. If you look at their cash flow on an annual basis, they've got 50 billion, 50.5 billion in terms of operating cash flow as at the year end in 2022. If you look at their balance sheet, they've got 185 in assets, 60 in liabilities. Their cost of capital during this mature stage is likely to be low to medium. They should be able to get the best rates when they're raising debt finance. During the maturity stage, the business risk is also likely to be low to medium. They've got a proven business model and value proposition that's working for them. In terms of funding sources, they have every option available to them. They can use debt, they can use equity, they can use retained earnings. They've got so much money, they can simply rely on retained earnings if they wanted to. They've even done share buybacks, like a lot of other tech companies have done. Apple have been buying back shares. Now, in terms of dividends, during the maturity stage, you're likely to see companies pay out dividends. However, Meta don't provide dividends. Now, dividend policy is a separate topic, but usually it's startups which don't pay out dividends. If you're investing in a startup, your appreciation, your return on investment will come from appreciation of the share price. Just speaking on Facebook, because I think they're just a great example to use. So if we're still looking at this life cycle model, as a market leader during the shakeout phase, you're looking to reinforce cost and differentiation advantages, and this can come from communication and marketing. You'll see a lot of established players spend a lot on marketing. You'll also see them trying to drive out weaker competition by innovation or by price wars, or you'll see them acquire weaker competitors. And you've seen Facebook try to acquire Snapchat in the past. I can't remember how much it was. I think it was for $3 billion they tried to acquire Snapchat for. Now, the owners of Snapchat didn't sell, and what did Facebook do? They basically copied all of their features which are key to their value proposition, and implemented them into their own products and services. They implemented them into Instagram. They implemented them into WhatsApp, which Facebook also brought. Snapchat isn't even really a competitor to Facebook anymore. If you look at Snapchat share price now, it hasn't done much. You understand? It hasn't moved at all, really, since it got listed. It peaked out at the end of 21, like a lot of these other companies, other tech companies did with the money printing. But let's say if we go before that, before the fall, before COVID, let's say, it was just teetering, it was just failing to break past 18. Like in terms of high barriers to entry, you're not going to get another competitor come in and disrupt these top four social networks like TikTok, for instance, Instagram, Facebook, Twitter. It's very unlikely and probably damn near impossible that a new startup comes in and overthrows or becomes a market leader within this space or the social media space. So this just goes to show that the market is mature, yeah, which means little to no growth. Why is Meta trading like it's still a growth stock with a PE ratio of 33? Because you're in a mature industry and there's little to no growth, what companies tend to end up doing is trying to cut unnecessary costs and become more efficient in their processes to increase their profit margin and therefore maximizing shareholder wealth. Now, there are different ways to grow. You can look at Ansoff's growth matrix. So you've got market penetration, you've got market development, you've got product development, and you've also got diversification. So in terms of market penetration, you've got increase in sales of existing products into an existing market. In terms of market development, you basically focus on selling existing products into new markets. In terms of product development, you focus on introducing new products to an existing market. And the riskiest one is diversification, which is entering new markets with altogether new products. And you've seen Facebook explore product development and diversification through the Oculus Rift, aka new products into existing and new markets. But in terms of market penetration and market development, let's say most of Facebook's revenue comes from advertising. Okay, that's how they make most of their income. When Apple changed their policy and basically shut off advertising, Facebook's ad revenue dropped significantly. Hence the push into the metaverse and this exploration of the metaverse. Okay, so Meta are trying to find new ways to justify this PE ratio, of 33. Meta have already penetrated with Facebook, with Instagram, with WhatsApp, let's say. How many more users do you need? They've already saturated US markets and European markets. 71% of the entire US population are Facebook users. Now, that's not to say that they're active users and that Facebook have been able to monetize all of these users. But if they haven't monetized them already, it's unlikely that they're going to be able to monetize them. When we're talking about market penetration, they're already at 71%. Do you understand what I'm saying? There's not that much room for growth in that market. China's basically off limits. If we're looking at Meta on the NASDAQ here, you can see the growth from 2013 all the way up till Jan 2019. I think we've reached a ceiling here. I genuinely think we've reached a ceiling here. And I say this, and the reason why I say this also is if we look at the money supply, right? Now, I'm going to show you this chart which I use, and basically this shows the NASDAQ through the lens of the money supply, okay? M2 money supply. Now, I'm using the NASDAQ because, let's say, the Magnificent Seven, yeah, which Facebook is a part of, contribute the most to the NASDAQ's performance, or has contributed the most to the NASDAQ's performance over the last year at least. So when I'm looking at this chart, I've drawn the boundary lines. Here you've got 0. I don't know what happened to TradingView because they used to show the numbers. But if it's below 0, it's a great time to buy. Yeah, that's a perfect opportunity. So you've got 0, 0.5. Those are the good boundaries. Then you've got 1. Then you've got around 2. And then you've got 3. Now, anywhere between 0 and 0.5 is a safe boundary for equities, okay? In comparison to the dollar, as a ratio of the dollar, or as a ratio to the money supply, yeah? Here, this boundary here is 1 for 1. So normally I would DCA, but best believe if we go below zero, if we are at zero or below, that is the best opportunity to put in a lump sum. Okay, and that's happened on 2 occasions. It's happened during the dot-com crash during 2002 and also during 2008, yeah, financial crash. So you got from 2003 all the way up to 2008. That's a 5-year period. Okay, again, you've got basically from 2009 to 2013. Yeah, more or less a 4-year period, but it's within 5 years. Okay, and this is kind of when globalization started to happen and when you saw the major improvements in technology. So 2013 to 2018, that's still a 5-year period. Now, we've never crossed over 3. When equities have reached a 3-to-1 on the money supply, there's always been a crash. Okay, history has shown us, and that was during the dot-com era, right? You can see us, we can't break past 3. That's why I'm expecting a crash. This is why when I look at Meta and it's not able to break past 300, where it's finding resistance. When I look at Netflix, when it can't break past resistance, this is just overvalued, way overvalued. It can't break past there. When I'm looking at Google and you see it peak in December 21 and it can't break past, I don't see us breaking past here, even with AI. So you can see here in January 22, when the Fed started talking about quantitative tightening and raising interest rates, you can see that we was on this decline, all right? We didn't get back to a 1-to-1 ratio. We need to get back to that level. Like, you would never think that a pandemic happened at this rate, which is why I believe that a correction is coming. I don't see us blowing past or setting new all-time highs. Now, that's part 1. If you found this video helpful, insightful, if you found it of value, please hit the like button and share it with a friend. Feel free to subscribe. It really does help with the algorithm. Or if there's anything that you believe that I've missed out or if I've missed, please share it in the comments below. I will be doing a part 2 where I go into a few more details. But this is Pell at Block 101, home of value investing in disruptive innovation and tech. I'll see you on the next video.